Welcome everybody to the price proposal preparation class on October 6th, 2022. I'm Tiffany Scroggs with the Washington PTAC program, joined here today by Terry Homburg. And we'll go ahead and get started. There are 5 handouts affiliated with this class. As we go along, it'd be helpful to have those handy. But with that, let's dive into this material. Terry, take it away.
Thank you. I'm really excited about offering this class. So this is a follow-on class to my class in August titled Solicitation Review, Making the Go, No-Go Decision. So you reviewed a solicitation and you decided to go, meaning you are going to compete for the award of the contract. Now you must prepare a cost proposal. This is the class to guide you through that process. Another upcoming class is how to write a winning technical proposal. And that class is scheduled for January 25th next year. And next month is a class on everything you need to know about contract modifications. And that's scheduled for November 15th in the morning from 8 to 10 a.m. All right, so why did I prepare this class for you? I've had many companies as PTAC clients that do not include everything in a cost proposal because they don't know about the costs or they don't know how to compute it. So I created this class to help you prepare a complete cost proposal by identifying the various components of a cost proposal. So if you win the award of the contract, you don't start losing money on the first day of performance. While this class covers various potential components of a cost proposal, you may not have some of the costs in your industry or your business. I selected a worst case scenario, a large procurement. Large procurement in federal contracting are procurements that have a value greater than $250,000. And they'll provide many more components of a cost proposal. So as Tiffany mentioned, there are a number of handouts you should have received and printed my PowerPoint presentation. First page is on the screen there, and 5 handouts. So you can make notes on them for future reference. We will be referring to the handouts throughout the class, so have them with you and available. A little background of my experience. I retired a few years ago with 29 years of federal procurement experience as a contracting officer with the Department of Defense, with the majority of my experience in construction, architect engineering, service contracts, both pre-award and post-award. Half of my career was in Japan, Cuba, and Italy, and the rest of my time was at various Navy installations around Puget Sound. I started working for PTAC the day after I retired. Today, I have a guest speaker with me that will present options for you on paying fringe benefits to your employees. She is Michelle Natardi from the Boone Group. Michelle, are you here?
Yes, I am. Thank you so much for inviting me. I'm excited to be here and do this presentation with you.
All right, very good. Thank you. There will be a survey after the class. I want you to complete it. This will help me improve this new class for future attendees. So please complete the survey when it becomes available to you. As far as questions, it's kind of a short subject, short class. So I will be taking questions throughout the class, or you can jot them down and ask them at the end of the class. So if during the class you have questions, please raise your hand or put it in the chat and I'll answer your questions during the class or at the end during the question and answer period. So before we get started, do we have any questions from you?
I don't think so. I think we're good, Terry. I am sending the slides to one individual, and if anyone else needs them, let me know, the slides and the handouts.
Also, I'd like to know that we got over 20 attendees right now as we're working towards 30. How many or who is not in the state of Washington? Are you from Oregon, Colorado, Idaho? It might be useful because in this presentation, we're going to be talking about taxes that don't necessarily apply to out-of-state people. So do I have anybody that's out of state? Is everybody from Washington? Okay. All right, well, I'll briefly go over the tax situation so you're aware of it. Because if you compete for a contract in another state, you're going to need to know about their taxes also. Okay, so there's slide 1. There's a few pictures on there, things you need to know about putting a cost proposal together. We got profit, bonds, taxes, and there's more things too. All right, so our agenda today is learning the components of a price or cost proposal, understanding indirect costs, that's overhead, tax consequences, and the impact in getting it wrong. All right, the components of a price proposal. You have direct costs, indirect costs, profit, bonds and insurance, and taxes. Now, throughout the PowerPoint presentation, you'll see some red asterisks. What I've been doing in recent classes is identifying those subjects for which we have another specific class. And in this case, we have a class dedicated to indirect costs. So you'll see that throughout the PowerPoint presentation today. All right, speaking the language. It's important to not confuse people in conversation by using the wrong vernacular, wrong terminology, especially when it comes to federal contracting. And a lot of this also applies to local government contracting also. So the first is proposal types. Lots of people interchange cost and price proposals. They are definitely two different things. A cost proposal is where you'll have to identify your direct costs, your indirect costs, your profit that you want, your taxes, insurance, so on and so forth. It's a line item, and a lot of you probably already have software for putting a cost proposal together. I had a colleague a couple of decades ago who, when he had to put a cost proposal together, he pulled out his legal pad and started writing down his line items and looking up the costs and putting it on there. He was old school. It was all old. It was all on paper. I'm quite sure that's pretty much all in the past for you. You probably have bought software, or you've developed your own Excel spreadsheets and templates to put your cost proposal together. But whatever method you use, you're going to be covering the basic components of a cost proposal that we just talked about, which is direct, indirect, profit, taxes, bonds, insurance, and whatnot. However you arrange it, you just got to make sure that you include all those components of a price proposal to make sure that you are submitting a complete proposal that you're not going to lose money on starting day one of a contract. All right, so a cost proposal is all the line items that add up to the bottom price that you're going to offer. So in some solicitations, the agency is going to ask you for a cost proposal, vice a price proposal. So you're going to have to provide your working sheets of your direct costs, your indirect costs, your profit, your taxes, your bonds, and so on and so forth. That is a cost proposal. Now, when you add up all those costs, you come up to a grand total at the bottom. Say it's $1.6 million. In some solicitations, they are asking for a price proposal. A price proposal is that $1.6 million. They don't want the rest of your cost proposal. All they're asking for is your price. What is your price for doing what we want, what we're asking you to give us a price on? That's a price proposal. Okay, so don't confuse them. They are completely two different things. The next is solicitation types. In a competitive environment where the agency issues a solicitation to the public and any number of companies can compete for it, that is a competitive environment. And so typically the agency is going to ask you for a price proposal, not a cost proposal. When there's competition, the agency only needs a price. What is your bottom line price for doing this statement of work? And as we talked about in the previous one, $1.6 million. Well, that's all you're submitting in your proposal to that agency. Is your bottom line price to do what they're asking for? The next two types of solicitations is sole source and single source. I hear people all the time interchanging those titles. They are two different types of solicitations. A sole source is when there is only one company in the United States that can provide that service or that product. That is sole source. Single source is very common in the Small Business Administration 8A program, where a contracting officer finds an 8A company that can provide the service or the supply, and they petition the Small Business Administration that we found this company, we would like to issue them a single source solicitation. So there are many 8A companies that can do it, but the contracting officer has found one and probably had a meeting with them and determined that they have the capacity and the capability and the interest to fulfill the agency's requirement. The SBA reviews that and says, yes, proceed. That is a single source. So there were many companies, but the agency found one that can fulfill the requirement. It's below a certain dollar threshold, and they asked for permission from the SBA to issue a solicitation to just that one 8A firm. That is a single source solicitation. Okay, so there's a difference between sole source and single source. So you're improving your vocabulary here with that information. Moving on. That's where we're at. Yes, so we're on handout number 1. This is the cost estimate. So I'm going to unshare. Let's see. I'm over 40, so I need reading glasses. Okay.
So it looks like, Terry, I can I can steal your share.
Oh, wonderful. Thank you for stealing.
I can't give it back to you. You got to steal it back when you're ready. But
okay.
If I'm successful, you all should be seeing an Excel file on my computer right now that says cost estimate.
Right. So
yes,
this is one,
thank you.
This is one of your handouts that I want you to turn to. What I've done here is created a very simplified cost estimate. And as you go down through that page, at the top, you'll see direct costs. That's the labor portion of your direct costs. Next is materials, followed by equipment. So as you move, can we move down? Move down to the second half of that page, we'll see, you'll find subtotals throughout there too. So under direct costs, I just put one piece of equipment, it's a truck. We got a subtotal for the equipment costs, and then we move down to a total for all the direct costs, which is labor, materials, and equipment. And then we go into the indirect costs. So here, there's a computation there of 0.122. That is 12.2%. So you, the company, have determined that your indirect cost rate annualized is a percentage, and it came out to 12.2%. So you're going to apply that to your cost proposal. Next is profit, which will be, we've got a slide on that, and we have a slide on the indirect rate also. So profit can have different terms for that, that word profit. It can also be called fee. I call it the greed factor. How greedy do you want to get? How much money you want to make? You got to be careful there, because you ask for too much, you can not get awarded the contract because your price is too high. Okay, and further down below profit is bonds. So typically in a construction project, you're going to have bonding requirements. With your proposal, you're going to have to submit a bid bond. Well, you got to go to a surety and pay for that. So put that price in your cost proposal, your cost worksheet. In another example, in construction, after award, you have to provide payment and performance bonds. So you're going to get a price from your surety. They're going to want to know, well, what's the value of your proposal, and that's how they're going to compute how much that payment and performance bond is going to cost you. Put that cost in your cost worksheets that you're working on. Then we'll get into B&O taxes. Washington State has B&O tax. It's a source of revenue for the state. But what a lot of companies don't know and a lot of contracting officers from the various agencies don't know, is that the state is not the only entity that levies B&O tax in the state of Washington. The counties and the cities do too. So you got to put those line items. It's all based on where you're performing work. So this is a very simplified cost proposal, but it's got all the components in here that we'll be reviewing and coming back to this this worksheet. So you can see in blue down there that all of this, the grand total for this cost proposal is $6.2 million. And we'll be talking a little bit about that too. All right, so let's go back to the presentation.
Do you want me to just pull it up? I think I have it open, Terry.
Okay.
Oh, just kidding. I don't have it open.
26 attendees now, I see. Okay, that's including you, me, and Michelle, and Lisa. Okay, so probably pretty close to 21 still. Okay.
Almost there.
Okay,
Got it.
so we're going to be on page 6, titled Direct Costs.
Okay. You guys don't see my presentation mode right now, do you?
All right, so
Sorry, go ahead, keep going. You got it.
okay, so under direct costs, you'll see on that screen that there is labor, materials, and equipment. So let's start out with labor. The labor acts may apply. So this is something that you need to look for in your solicitation. So if the requirement is for a service like grounds maintenance or janitorial, providing a service, the Service Contract Act threshold is $2,500. So if the government has put together an estimate, because they have to put an estimate together also to determine if for another reason, what's the dollar value, and they got to go seek money from their customer, their client, and it exceeds $2,500 and is for services, then they have to include a wage determination from the U.S. Department of Labor. And so you need to be mindful of that because you have to pay your employees in accordance with that wage determination. Now, if it's a construction project and the estimated value of the construction exceeds $2,000, then what we used to know the Labor Act as the Davis-Bacon Act, that kicks in, and there will be general decisions from the U.S. Department of Labor, a labor decision in there, a wage determination in there, that you have to pay your employees at least that amount of money that's in there. I have provided you a website there to find the wage determinations. I might add at this time that it is your responsibility, not the government's responsibility, that you ensure that you pay your employees in accordance with the U.S. Department of Labor wage determination. There's been a court case decades ago, and the contractor lost that argument when they said, well, the contracting officer from that agency issued the solicitation, and there was no wage determination in there. And then they award the contract to me, and there's still no wage determination in there. So it's not my responsibility how much I'm going to pay my employees. And the judge said, no, you, the contractor, are responsible for knowing the correct wages to pay your employees. So you're on notice there. That's why you always want to check the solicitation to see if it may exceed the dollar threshold for the Davis-Bacon Act or the Service Contract Act. And if it's missing, send in a PPI, pre-proposal inquiry, and ask that contracting officer about that so they can possibly amend the solicitation and make it available, kind of like leveling the competitiveness of all the potential offers. Hey, putting everybody on notice. Oh, wage determination is in here now. I got to pay at least these dollar amounts for these blue collar workers that I have employed. So here's another handout. Let's go to that handout. It is a sample wage determination. Are we getting there, Tiffany? It's an 11-page U.S. Department of Labor wage determination. Okay. So I don't know how familiar the attendees are here. I'm going to assume, not the worst case scenario, but assume the knowledge base is contractors just getting their feet wet into federal contracting, for example. So this is a wage determination. The number of the wage determination is in the upper left. It's WD for a wage determination 15-5781, and this is revision number 7. Be mindful that in construction, the wage determinations used to be called Davis-Bacon Act. There's a new name for that, and Michelle is going to cover that in her presentation. That in construction, it is not uncommon for these wage determinations to change about every 14 days. So you got to keep current with that. As opposed to the Service Contract Act, which has now been retitled to a statute, which Michelle will talk about. Those typically only change about 2 to 4 times a year. So got to know what you're dealing with, and you always got to be making sure that the current wage determination is in the solicitation and in the following contract that gets awarded. So if we scroll down, I think maybe to the bottom of that first page, yes. Now you're going to start seeing labor categories, what they call occupation codes. So this goes on for pages, and it's your blue collar workers, not the management staff, not the superintendents, the project manager, the quality control manager, whatnot. Those are considered professionals. The wage determination is for the blue collar workers. So you'll see on here an accounting clerk, secretary, and further down you'll find the welders, the electricians, the carpenters, the truck drivers, the mechanics, and so on and so forth. In the far right hand column is the minimum hourly wage that you need to pay them. That doesn't mean, I get this question occasionally, is this is what I must pay them? No, this is the minimum amount that you must pay them. You can pay them more, you can pay them this, but you cannot pay them less than this. Okay. All right. So now let's go. We're getting close to the back. So wage determination is really, there's 2 parts to it. This is the first part of how much you need to pay your employees at a minimum. Now, if we go back to page 7, 8, page 8 of 11. Now we're getting into the other part of a wage determination, which is the fringe benefits. So not only do you have to pay your employees a minimum hourly rate, you also have to pay them fringe benefits. So on page 8 on this wage determination is the start of fringe benefits. And it says there, like, for example, health and welfare, you have to pay $4.48 an hour. Okay. I think this is a good segue. We can go back to the PowerPoint presentation, and Michelle will take over on letting you know your options for paying fringe benefits to your employees.
Yeah, Terry, if we could pause real quick for questions on the applicability of prevailing wage. Sorry, Michelle, if you don't mind, real quick, there's 2 questions in the chat. Yeah. One, it says, as owners of construction company, do we have to go by that wage determination if we're the only ones doing the work? So they're the business owners.
If the owners are doing the work, they're not subject to a wage determination. It is for their employees. The other aspect of this is there's potentially 3 different wages that you need to comply with. There are those of the state, there are those of the federal government, and there are those of the union bargaining agreements. So the requirement is you have to pay the highest of the 3. So if the U.S. Department of Labor wage rate, minimum wage rate for, say, a welder is $25 an hour, but the state prevailing wage rate is $26 an hour, and the local union bargaining agreement is $27 an hour, you're not going to be in compliance by paying the U.S. Department of Labor's wage determination of $25, you have to pay the $27. It is the highest of the three. And that may not be the same for the next blue collar worker, may be the carpenter. And it may be turned around that the US Department of Labor's hourly rate is the highest of the three. So it has to be the highest for that individual blue collar worker, your employee. And you got to know all three of them. Did I cover the question?
Yeah, the follow-up question is that true even if not signatory? I'm not sure.
Not
What that-
signatory?
Brenda, you feel free to unmute. We can,
Yeah, unmute and ask the question.
yeah.
Yeah, we're not a signatory contractor. So when we get to the point where we're hiring people, if the union wage is the highest wage, are we required to do that? Or to use that wage?
If you're not hiring employees from the union, no. If you're not a signatory to the union bargaining agreement and you're not hiring employees from the union,
Mhm.
I wouldn't think that you would be subject to that. So then you got to deal with the state prevailing wage and if it's a federal solicitation, then the US Department of Labor's wage determination. So that
Okay.
so the two.
All right, thank you.
You're welcome.
And then the determination about the location, it's not the location of where the business is headquarters, it's the location of where the work is being performed. Is that correct, Terry?
That's correct. So for example, if your company is in Bremerton, Washington, but the solicitation is for work to be performed at the Naval Air Station at Whidbey Island, it's going to be a wage determination for Whidbey Island, not for Bremerton. It's where the work is being performed. Okay. Great questions. Any more? Okay, Michelle, you got the deck.
Wonderful transition. Thank you. All right, so let's talk about fringe benefits. Next slide, please. So Terry talked about the labor acts that are subject to fringe. And so everyone that I work with still calls it the Davis-Bacon Act, but now it's officially called the Construction Wage Rate Requirement Statute. There's also state prevailing wage laws, local living wage laws, as Terry mentioned, and then the Service Contract Act, which is now officially called the Service Contract Labor Standards Statute. And as we saw on the wage determination, you are required to pay the base wage and you have a fringe rate on top of that. And you can either pay that fringe rate through payroll, through cash, or you can put it towards a bona fide benefit. And it's up to you, the employer, on how those dollars are going to be used as long as it goes to each individual. Next slide. And as a contractor, you want to be successful. And so in order to do so, you got to make sure that you're staying compliant with these government contracts. And you also want to be able to save money, be profitable. And so when you're putting the fringe dollars towards benefits, you're not paying taxes on those dollars. But if you pay it in cash, then you have to pay those taxes. So really it helps you be more competitive on your bids if you're bidding in a way that the fringes are going towards the benefits. So it'll help your win-loss ratio as well. Next slide. So why should a government contractor be concerned about fringe benefits? Well, we touched on compliance and cost and profits. Terry also talked about union collective bargaining agreements. You need to make sure that you're paying the higher of the two, whether it be state prevailing wage or federal wage. And there's also executive orders and compliance. And in addition, you all might be aware of the Affordable Care Act, but if you have a business that has 50 or more full-time equivalent employees, then you're actually required to offer benefits. And you also want to meet your employee expectations because so many people are out there looking for employers that offer a robust benefits package. Next slide, please. So what must a contractor do to satisfy the fringe benefit obligation? Next. So it is really unique. And here's an example. So let's say you have an $8 fringe on top of the base wage, and you have an employee who is working 160 hours per month. Well, then you have $1,280 a month to spend on benefits for them. And you can put this into a major medical plan, dental, vision, life insurance, and you can put the rest in retirement as well. And again, it's up to the employer if they want to offer these benefits. Next slide. And so here is an example. So this is the cost saving analysis. In the middle column, you can see what happens if you just pay that $8 to cash. And then on the right column, you have what happens if you pay those dollars into benefits. And so basically, this is just an example, but you're saving about 81 cents an hour with that $8 fringe that you would otherwise be paying taxes for. And if you have a full-time employees, you're saving about $1,684 a year. And if you're a company that has 50 employees, then that cost savings would be $84,000 in a year that you would otherwise be paying out for taxes if you're paying these fringe dollars into payroll versus benefits. So that just kind of puts things into perspective there. And next slide. So this is kind of a recap. So advantages of using fringe dollars for benefits. It reduces your workers' compensation and general liability, actually. It reduces your payroll tax burden. It reduces job costs. You're able to be profitable. And then you're just going to be winning more bids. Next slide. So how does a contractor position themselves correctly, but also keeps up with employee expectations? All right, next slide. So here are some strategies to win contracts. So you don't have to spend more than the fringe that's available. So you can really maximize those dollars and put together full-time or part-time plans. If you have variable hour workers, there are solutions that can really help you use those dollars so that you're not dipping into your profits to pay for benefits. So there are unique hourly plans out there that you can enroll into. And you can also, if you have a lot of excess fringe dollars, you can put them into an hour bank. A lot of construction, in the construction industry, there's usually higher fringes. So basically, it's kind of like an individual premium reserve where you're putting excess fringe, you're not getting taxed on those dollars. And then when a contract ends and your employees are not getting paid fringe anymore, you can pull money from that bank and continue their benefits. And that really helps you kind of retain on to those key employees that you have. And then lastly, just putting together a comprehensive benefits package that include all of the things that are listed there. Next. And so that's it for my part. So we'll open it up for questions.
Yeah, so this is really important for all the attendees here. When addressing fringe benefits, you have options. Instead of paying the employee the fringe benefit dollar amount that's on the wage determination, in this example, it was $8 an hour. So if the wage determination says you got to pay the welders $25 an hour, and the fringe benefits is an additional $8. So what a lot of small companies will do is just take the 25 plus the 8 and put it in the employee's check. So the employee gets that fringe as cash, as Michelle mentioned. But the other option is what Michelle just went through. You're lowering your taxes, you're being more competitive, you're increasing the possibility of getting more contracts because the price proposal or the cost proposal that you're submitting is less than your competitor if you are choosing to do as Michelle said. Choose to have, instead of paying the benefits in cash, but paying it in benefits. So we have any questions on this? It's quite a concept, especially for new businesses, or especially those that are expanding and getting into federal contracting.
We did have a question about it being applicable to both the federal and state prevailing wage requirements, that there would be this add-on fringe.
Yes, it's both federal, state, and local. There is some collective bargaining agreements that actually have it too, and it should be found in the wage determination, how much those fringe dollars would be.
Any other questions?
Dustin,
Feel free to
I
unmute.
I just had a question. So how does it work when there are a number of benefits that, like with a benefits package a company offers, when, like, let's say the employee, maybe it's company policy that the employee isn't eligible to start like medical or dental until after 3 months. How does that work into, are you still able to take that credit on your taxes, or kind of how does that work?
yeah, well, you can separate different classes of employees. So maybe if you have private employees who work on private contracts, maybe they could be subject to the 3 months, but then if you have a fringe wage, then you can start your benefits right away because it's coming from the contract. So it's just really up to you, the employer, on how you want to go about that. You could maybe put the first 3 months into an hour bank as well and kind of use that as an excess premium reserve. So you can kind of be creative on how you want to go about that, but there are multiple options.
You talk about if this is applicable to both construction as well as professional services like engineering. How does it impact those companies?
Yeah, so professional services, it would be like if you have hourly workers who are subject to a fringe, usually the fringe dollars are lower, so they're $4 and some change. And so if you have those workers, yes, it's still subject to that. With construction, you have fringes that are 10, 20, even $30+ an hour. So you just have more flexibility on how to utilize those dollars, but it's the same concept throughout various industries.
Yeah, so keep in mind when it comes to professional employees that we were just talking about, the U.S. Department of Labor's wage determination is not for the professionals. It is not for the engineers. It's not for the doctors and lawyers and the project managers and the superintendents, whatnot. The U.S. Department of Labor's wage determination is for the blue collar employees, the people who turn the wrenches, the welders, the carpenters, the electricians, the secretary, the bus driver, the truck driver, so on and so forth. So typically the professional staff of a company, they have employment contracts with the employer. And so they negotiate what their compensation package is, what their hourly rate's going to be, their fringe benefits, medical, dental, retirement, 401ks, and all that kind of stuff. So, so we're talking about two different groups. Yeah, they both have fringe benefits, but they're treated differently because one's a blue collar employee subject to Department of Labor's wage determination in a federal contract, and the other is in an employment contract with the employer, talking about their compensation package for working with the company.
Yeah, so there are exempt people who wouldn't get the fringe. And so, yeah, like what Terry said, it's those hourly workers. I mean, you can still have like people who do recruiting that are subject to fringe dollars, or, there are still more office type jobs that are subject to fringe, but yeah, it would have to be in the wage determination, and you as the employer should know if they're subject to that or not. But the engineers are typically exempt.
Right. Any other questions on fringe benefits?
I don't see any right now.
Okay, thank you, Michelle. And certainly everybody, you'll have an opportunity for questions on everything on the class at the end in our question and answer period. So jot down your questions. If you don't want to ask them now, you can save them for later.
And Michelle, feel free to put your contact information direct in the chat too, if you'd like.
Okay, yes, thank you so much for having me on. It was such a treat.
Thank you, Michelle. Okay, so we're going back to our PowerPoint presentation and we're continuing on direct costs. So we finished with labor and now we're moving on to materials. And your material costs could come from your suppliers and vendors where you got to buy materials. You want to check your solicitation for Buy American Act, the requirements to buy materials by US manufacturers as opposed to buying them from China or Taiwan or Korea, wherever. And also check in your solicitation for that third bullet, prohibited sources in a solicitation. So for example, in the Department of Defense, they have a clause or more than one clause that says if you are providing tungsten, for example, or steel, or any list of materials, cobalt, there are restrictions of countries that you cannot purchase it from. So you want to be mindful of that. It is common, and I've administered many construction contracts in my 29 years, where I have my contracting office representative, construction managers, engineering technicians who go out into the field, onto the work site on a daily basis, and see how the progress on the site. And a contractor may have put in some materials and there's a tag on there made in China. And in the contract, it was prohibited. And so we, the government, the contracting officer gets involved in and has to tell the project manager, hey, you've got to take that material out. And you've got to go get the material from a US company or from a country that is authorized that you can buy the materials from. So that commonly happens because of a number of things. The contractor won the award and they may have put in pricing for a US company, but they're cutting corners to make more profit and they're buying it and they think they're going to get away with it. Or they didn't read the solicitation and found the Buy American Act clause in the solicitation in the contract, or they didn't see the listing of prohibited sources in the solicitation. So that's why it's so important to read your solicitation, every line in the solicitation, all the amendments and all the associated documents. And that's what we covered in my class in August. Review of a solicitation is so important to cover it all, to know what's in there, so you can put your price proposal, your cost proposal together accurately for where you got to buy your materials. Okay, now we're moving on to equipment. So we're still on the previous page 19 on equipment. There's two categories of equipment. You can lease it or rent it and put that projected cost in your cost proposal, or maybe you're a company who owns your own equipment. So the thing to be mindful of here is in your cost proposal, you may be asked by the contracting officer to submit a cost proposal and all your associated supporting documentation. Well, if you're going to rent, say, a cherry picker for a construction project, you're going to get a rental agreement or a lease agreement from that leasing or rental company, and that's your supporting documentation. And the contracting officer is going to accept that. But if you own it, you're not going to be using the same rate because you own it. And what I've provided here is a website for you to find from the Army Corps of Engineers. They have a published manual. It is EP 1110-1-8 for companies who own their own equipment, and you can look up the truck or the forklift or the excavator, whatnot, and see the life expectancy of it and what is the price per day, per week, per month of company owned equipment, and put that in your price proposal. And if you do so, even if you get challenged by the contracting officer during a negotiation for that rate, you can say, I got it from the Army Corps of Engineers manual, and that is a fair and reasonable price, and the contracting officer is going to accept it. Okay, All right, ready to move on to the next page. Any questions on the direct costs? Labor, materials, or equipment? Yes.
I've got a quick question, Terry. Do you know, does what you just mentioned with the Army Corps of Engineering pricing, would that count if, let's say, my company was a subcontractor to another company who was paying for rental vehicles for employees to, it's a per diem, a contract. So they were paying for or reimbursing essentially my company for the costs of associated rentals. And we went out and purchased a vehicle. We should be able to go to this website and say, hey, just because we're not renting a car from X, Y, or Z company and billing you for it, we are now going to bill you on a daily basis for what's identified in this.
Yeah, so are you saying though that you submitted an initial proposal to the prime contractor and you put in a rented rate, and after you got the subcontractor, you switched and went out and bought a vehicle?
Well, in this, we'll say hypothetical, this is kind of like my company was hired into essentially just as a labor pool. So we're probably 3 or 4 tiers down on the subcontractor from even the prime.
Sure.
And so it was originally set up to where my company did have rental vehicles, but along the course of it, with people, coming and going as the job picked up or slowed down, we ended up procuring a vehicle because it was about $170 a day per vehicle, and we had about 4 rentals. So
$170 per vehicle per day.
exactly.
Right.
And so looking long term, we're like, well, let's invest in a vehicle that we can use as well.
Mhm.
So I'm just wondering how or if we're able to, and maybe not on this one, but on a future agreement that we sign into, we would be able to use this site.
Yeah, so 2 aspects there in your scenario. One, you got a subcontract. I'm assuming it's firm fixed price, not a cost type contract.
Mhm.
Okay, because type of contract has a lot to do with pricing. So you got a firm fixed price, you submitted a proposal, the prime contractor awarded a subcontract to you based on your proposal that provided for 4 vehicles, $170 a day for each one, and you won the contract. After you got that subcontract though, some months down the road, you found that that's going to be more economical because you're in it for the long run to go out and buy them. You don't need to disclose anything to the prime contractor. They've already awarded the contract to you as a firm fixed price subcontract, and that's fine. Now, the other part of your scenario is competing for another contract in the future. Now you own the vehicles. Yes, you would want to use the Army Corps of Engineers manual, look up the type of equipment or vehicle and use the pricing that's in that manual in your proposal to compete for the subcontract. That's how it works.
Great, thank you.
Okay, great question. Any other questions on direct costs, labor, materials, or equipment? Okay, we're moving on to indirect costs. And you can see there we have another red asterisk. We have a class dedicated just to indirect costs. And so that's what that red asterisk is for. If you want to get more into the weeds and the details of your indirect costs, how to compute them, what's allowable, what's reasonable, what's allocable. Those are the 3 terms in federal contracting for when it comes to costs, is allowable, allocable, and reasonable. We have a class just on that. So the various names of indirect costs. There's general and administrative, what we call G&A. There's home office overhead. In construction, they have 2 types of overhead. They have on-site overhead and home office overhead. Some companies just call it their indirect costs. Now, some companies can have both G&A and home office overhead, and other companies will put them all together into one pool. Both are fine. You can separate them out or you can combine them. Doesn't matter. So you need to determine what's allowable and how to calculate it. We have a worksheet for that. I have helped about 3 companies this past year develop their indirect costs, and they're now using it in their proposals. So here's another handout. It's a 1-page handout, and it's titled Federal Contract Overhead Expenses. So this is a worksheet that will help you jog your memory of the types of indirect costs to include in your pool of expenses. So things like the owner of the company, their salary, the vice president, the accountant, the bookkeeper, any bonuses that you pay to the office staff at the headquarters. So you look at liability insurance, you can go down that list and see your office radios, your website costs, running your internet, office rent, utilities, your office computer, the printers, the toner, the office supplies like the toner, paper, pencils, all that kind of stuff. What other things? Life insurance, medical insurance, office furniture, vehicle registration, vehicle insurance, the gas to run that car for the headquarters. Oh, a new one that came up 2 years ago is companies that want to work with the Department of Defense. You got to get your cybersecurity, you got to get your IT system up to snuff in order to get future contracts with the Department of Defense, even as a subcontractor. Well, it's going to cost you money to have your IT department, or you subcontract out to an IT company, or you go to the cybersecurity accreditation body and get help from one of their vetted companies, and that's going to be an additional expense for you. Well, that is the only way that you can get covered for that expense is by putting it in your indirect cost pool of expenses. So I've just recently added this line item on this worksheet, cybersecurity. Any training expenses to keep certifications current, travel expenses, postage, whatnot. So this worksheet gives you things to think about. Oh yeah, I got union costs I got to put in here. Yeah, I can put it in here. It's allowable. So the other thing that you need to be mindful of is some equipment like your office sedan or your office truck. There's a life expectancy for that, and I have provided the website there for you. It's one of a number of websites that you can use, and it will tell you the life expectancy of equipment or office furniture, for example, a computer. And on my worksheet, I have a few of those. So for example, a laptop computer, the life expectancy is 6 years. So in this example, I put down the cost of the laptop is $439.80. The life expectancy is 6 years. So you divide your acquisition cost by the 6 years, and that's how much you can put in for each year for your indirect costs. In this case, it was $6.11, and that's per month. So per year, it'd be times 12. So the other thing that I mentioned on the PowerPoint there under the worksheet is the first bullet is normalizing. You may recall in a high school math class, the terminology normalizing. So not all these costs are incurred at the same rate, like weekly, monthly, quarterly, semi-annually, or annually. So you're going to get a cost for, say, insurance, which you have to pay twice a year. So if your cost is $250 every 6 months, you're going to put it on the worksheet, but you got to normalize it. You want everything to be by month. So you've got to do the math and put down the monthly price. That's normalizing your cost information in your pool of indirect expenses. And then you add it up at the bottom. And in this case, it came out to $103,000 for a year of indirect costs. Okay. Further down on the bottom of that worksheet, so on this worksheet, it shows that the annual cost of your indirect pool is $103,000+. Now you can then get it down to a monthly rate, a daily rate, and an hourly rate. So depending on the solicitation that you're entertaining, competing for the award of a contract, in some cases you may have to use a daily rate. In other solicitations, you're putting in an annual rate, which is a percentage. So you got to go through another calculation, and I've done that here on this worksheet down at the bottom. You're putting in your projected or expected annual revenue for the current year. So if you plan on, say, commercial and state government contracts and federal contracts, in this case, I did a projection of $1 million. Our company is going to get awarded or have contracts in the value of $1 million. So you take that and divide it by your indirect cost pool of $103,000, and in this case, it comes out to 10.34%. So that is your indirect rate that you're going to put in your cost proposal under indirect. Remember, the one that I showed earlier in my example was 12.2%. Well, for your company, you do this computation. If it comes out to 10.34%, that's what you're putting in your cost proposal for indirect costs. If it's the type of solicitation where they're not asking for a monthly rate or a daily rate or an hourly rate for your indirect costs, then you can just put in your percentage and apply it to the subtotal above to arrive at your bottom line cost. I also put on the very last line on this handout is B&O taxes. Some companies put B&O tax, business and occupation tax, in their indirect pool, as opposed to applying it to a proposal as a, you might call it a direct cost for this particular contract. Either way works. My preference or my guidance would be is you put it in your price proposal at the very bottom, identifying all the B&O taxes that you may be subject to for that location where you're going to be performing, as opposed to putting it into your indirect costs. But either way works. It depends on the nature of your business. So any questions on indirect costs?
Yeah, can you go over normalizing again?
Sure.
Raven asked, where and how do you normalize overhead?
Okay. So let's turn to this handout and let's go to the very first line, the owner's salary. This particular owner gets what, 30, let's see, it's $3,000 a month. If you were to take that times 12, you'd get what, 36,000? $36,000 a year. Normalizing it, because what you want to achieve is have the same unit of issue for every line item on your sheet. In this case, the unit of issue is monthly. In the far right hand column, the period says, for this example, is everything has been normalized to monthly. You can normalize it to whatever you want. It can be annual. So if you get a monthly utility bill for electricity and it's $30 a month and you're normalizing it to a year, then you take the $30 times 12, and that's what you're going to put on here. And under your column for period, you're going to put year instead of what I have here for month. You're normalizing. Every line item has the same unit of issue. So I mentioned example earlier, insurance. Auto insurance is typically every 6 months. So you get a bill every 6 months, but you're going to normalize it. In this case, I normalized it to the month. So if my bill for auto insurance is every 6 months and it's $600, then I'm normalizing it down to per month. I'm taking 600, dividing it by 6 because it's for a 6-month period, and I'm getting $100. I'm putting auto insurance on here for $100, and under the period it's per month. That is normalizing the data. Did I cover that?
I think so.
Okay. All right, so we got the indirect example there. Those are just things for you to think about. So as I was working with the clients over the past year, I would share this worksheet with them, and the light bulb would go on. Oh yeah, I got those expenses too. I didn't even consider those. So you want a comprehensive list of all your indirect costs. What I found working with the PTAC clients over the last 3.5 years, when working with price proposal, putting their cost proposal together, they were, let's say, clueless on indirect costs, how to compute it, what can be included, what can't be included. So one of the things you need to remember in commercial industry, the things that you can put in your indirect pool, you cannot put in a federal contract indirect pool. So if you're doing business with the federal government and doing business with the commercial companies, you may have you need to compute two different rates. So in your proposals for commercial industry, your indirect rate might be 13.5%. But when you're putting a proposal together to compete for the award of a federal contract, your indirect rate might be 13.1%, because there are things that you cannot put in your pool of expenses for a federal contract that you can in commercial industry. I think we covered everything on the slide. Any questions on indirect costs?
Terry, will you talk about where that list of naughty expenses are, the unallowables?
Yes.
And where to find that?
We've got one
Okay.
more slide on
Okay,
indirect
good.
costs, and it's on there. So let's go to slide 21, and we'll talk about the remaining issues on indirect costs. All right. So to find out for federal contracting, what is allowable and allocable is in the Federal Acquisition Regulation Part 31.205, titled Selected Costs. I provided the website there for you, and in the regulations, it goes on for pages, the different things like the use of a pickup, the cost for furniture, the allowable costs. It addresses all of those. One of the things that I had to deal with on more than one occasion as a contracting officer was companies that had pickup trucks that they gave to their employees to use on the job site. But the company also allowed the employees to take the truck home and use it for their personal use also. Federal acquisition regulations does not allow the cost for personal private use of a company's vehicle to their employees. The only portion that can be allowed is the use of the pickup on site. So you have, let's talk about a construction contract. You got your office trailer on the construction site, and say it's out at Naval Submarine Base Bangor. It's a big base. You've got it on the upper base, and you got to drive down to the lower base to the Delta Pier to do work. That's where the performance is for your contract. You're doing repairs to a dock or a pier. So everybody comes to work, drives on base, goes to the office trailer, and they get into the company pickup to drive down there. But in this scenario, they came to work in the company vehicle, came to work, and then they went down to the lower base to work on the dock or the pier. Well, the only portion that is allowable, according to the Federal Acquisition Regulations, is the miles that are put on the vehicle once it comes on the job site and works around the base. The miles that are driven by the employee taking it home and going to the grocery store or whatnot is not allowable. Okay, so that's what the regulations talk about. It goes into detail for each of the selected costs for your indirect costs. The next bullet, review the indirect costs regularly and make updates. So a couple of scenarios there. One is you've developed your indirect costs. These are the items that you've identified that your company has indirect costs for your corporate office. You know, you've got a secretary there, a person who's answering the phone, another person who's looking for solicitations all day long from various websites. Another person that submits invoices, prepares invoices and submit them and receives the checks from the companies paying for those invoices. So you've got a number of clerical staff. That is all indirect. They are supporting all your contracts. They are the support staff in the corporate office. You know, the office manager is there, the project manager, corporate project managers there. Maybe there's a corporate quality control manager that's in the home office. Those are all your indirect expenses. So you want to capture all those things. And maybe each person has a computer and a printer, and you've got company radios to communicate with people. Those are all costs that you want to include. Okay. And you're in a leased building, leasing one floor of a 5-story building. You got that lease expense. That is allowable. That's an indirect cost that you want to list in your pool of expenses and figure out what your rate is, the daily rate or an annual percentage rate to put in your cost proposals. So anytime, and this frequently happens, just me personally, I may switch insurance companies to get a better rate. Anytime any of those items in your list of indirect costs changes because you've gone out and got a better deal from somebody, and once you've got that better deal and you've got this new rate now, you want to go into your computation sheet here and change that, and that's going to affect your bottom line hourly rate or monthly rate or the annual rate. So that's why I say there, you want to check it regularly, and anytime any of these change, you want to update this. And maybe you decide not to do it each time that there's a change, but maybe you want to do it semi-annually, or you want to adjust your projected revenue for the year. In this case, I use the figure of, we plan on getting $1 million worth of contracts. Well, you get halfway through the year and it ends up being $2 million worth of contracts. Well, that's going to change your rate. That's going to cut it in half probably. Okay. So you always want to be reviewing your indirect rate. So as the third bullet says there, control and reduce your indirect costs to be competitive. Because if you can change your indirect rate from 13.1% and you're going out and being proactive, trying to reduce your indirect costs, and you find better, less expensive insurance or better deal on a company car, whatnot, you could change your annual percentage from 13.1 to maybe 12.7. And when you put that in a proposal, that reduces your bottom line price that you're going to submit. So that's being competitive. So it's important to control or reduce your indirect costs to be competitive. All right, so that was the second and last slide of indirect costs. Let's open it up for any questions.
Terry, could you, there was one question, just to clarify, the worksheet isn't comprehensive, just a great and helpful place to start.
Yes,
right?
Because there are different industries and different businesses that can have different indirect costs. This is just a worksheet to make you think about some of these costs that you can include. There can be others, you know, some companies might only have a third of these. I had one of the companies that I helped this past year was in the trucking business. Oh my gosh, he had like 5 line items of licenses and insurances that he had to cover, you know. So it depends on your business and the industry that you're in as to what type of or kinds of costs you have in your corporate office. This is just some ideas for you to think about. You look at these and you might think, oh, I've got this other cost, it's not on here, but can I include it? Well, you might go to the Federal Acquisition Regulation Part 31.205 and look it up and see if you can include it or if it's prohibited. Okay. Any
I
other
think we're
questions
good.
on direct costs? All right, let's move on to, oh, the exciting profit or fee, or the greed factor. Okay, the profit is based on type of contract. And what I mean by that is various types of contract have associated risk. Profit is based on risk. The greater the risk on you, the greater the profit. Because profit is associated with risk. Okay, so in the parentheses there, I have identified the extreme ends of the pendulum. Firm fixed price is the highest risk to the contractor, to you companies in attendance here. Firm fixed price contracts are the highest risk to you. So potentially your profit rate is going to be the highest on a firm fixed price contract. The opposite end is a cost type contract. And the government has the greatest risk on a cost type contract. So your profit rate is going to be less because you have less risk. Okay. But keep in mind and I've written down here, there are over 19 types of contracts between firm fixed price and a cost type contract. They are covered in FAR Part 16 of the Federal Acquisition Regulations that talks about all the different types of contracts. The agency that I retired from would be contract type number 20. Ours was not in the Federal Acquisition Regulation because it was a combination of two of those types of contracts. It was a firm fixed price contract plus indefinite delivery, indefinite quantity. We put the two of them together, issued a solicitation and made awards to contractors and administered those contracts. So agencies can come up with unique contract types, but you need to understand the type of contract that is being solicited and that's going to be awarded, because that affects your pricing. Okay, it's when it comes to profit and fee, it's about risk. Second bullet, based on risk. The higher the risk, the higher the profit. The guidance on profit can be found in the Federal Acquisition Regulation Part 15.404-4, which is titled Profit. So you can go in there and read about profit. I've also provided the website link for you also. So another aspect about how much profit do you want to put in your cost proposal, whether it's going to be 3%, 5%, 10%, 25%, applies, the next bullet applies to that. How badly do you need this contract? There are many reasons why you're going after a contract. One might be, for a number of you that are attending this class, is you've never had a federal contract before. You need to get your first federal contract so you can show you have experience in federal contracts. Well, in that case, you need that contract badly. Chances are, or what you probably should be thinking of doing, is putting a small percentage in your cost proposal, like 2% or 3%, depending on the industry that you're in and the type of contract, which is associated with risk, but a smaller percentage because you need to get that first contract. Maybe you need to get your second contract or third contract. So to be competitive, as we talked about earlier, you want to contain and control your indirect costs so that that rate that you put in your cost proposal is as low as you can get it to be competitive. But also, how badly do you need the contract when it comes to profit? If you really want to get that first contract, your profit rate is going to be lower because you need to get that first contract to show experience on your capability statement, or when you're talking to the agency small business specialist, they're probably going to ask you, have you had a government contract before? So it's all about risk. So the government agency's contracting officer is, you've got a number of capability statements from you companies out there, and they're looking down in the bottom right-hand corner of this front page of the capability statement, and they're saying, okay, you work for the state, you work for Boeing, You work for Microsoft, but I don't see any federal agencies here. So my cost meter is bing, it's going up. This could be a risky contractor, as opposed to a company who got a capability statement and shows that they've had a federal contract or maybe a subcontractor to a federal prime contractor. Oh, they work for the Navy, they work for the Department of Engineering, Department of Energy. So the risk meter comes down. It's less risky to the federal agency to award a contract to them, or they feel more comfortable awarding a contract to a company who has some experience. So they know about the badging process to get on the federal site. They know how to put a proposal together for a contract modification. They know how to submit invoices to get paid. They know how to attend meetings and take meeting minutes, so there's a comfort value in there. So your first federal contract might be a low profit rate. To the other extreme, you don't need the federal contract. All your employees are gainfully employed. You've got contracts stacked up and overlapping, and you're good for the next 2 years. You don't need another contract, but you are compelled for whatever reason to submit a proposal on this. And so you're going to put in a high profit rate. You don't really care about this, whether you get it or not. And if you get it, you got lots of profit you're going to make on this contract if you happen to win the contract. So there's everything in between also. There's all kinds of scenarios for you to contemplate how much of a profit rate do you want to put in your cost proposal. Another important thing when it comes to figuring out profit is knowing your competitors. So this is the last bullet on this slide. If the agency is issuing this solicitation for a contract that is about to expire, they're doing what we call a follow-on contract. So they've had this contract, maybe they've had it for many years. They had many contractors over the past 10, 20 years. And they're just this contract is coming to the end, and they're soliciting a follow-on for award of a follow-on contract, whether it's a 1 year or next 5-year contract. Find out who the incumbent is. Might be very useful to find out that they're going to be competing for the follow-on contract, or they're not going to be competing for the follow-on contract. Know your competitors' needs. Are they a new company that's going after their first contract too? So probably chances are they're going to have a low profit rate. Technology, your competitors' technologies. Sometimes in some industries, there's more than one way to skin a cat. There's tools that can help you do it more efficiently or faster or better, or produce a better quality product, for example. So what technologies are out there? Do you have the latest and greatest technology, or are you a couple of generations behind on technology? So knowing the competitors' technology, knowing your competitors' means and methods. So an example that I give, maybe I already gave it in this class, is a company that I negotiated with when I was in the shipyard. And it was the requirement was a service contract to clean all the windows in a 5-story building. So the contractor came in with a proposal to erect scaffolding up the side of the building to clean all the windows. Well, we didn't think that was a very efficient means, and it was going to cost more money because scaffolding is expensive to rent, and there's time to erect it and so on and so forth. And we were negotiating to have the contractor use a cherry picker. Go rent a cherry picker, lift the employee up and down to clean the windows. Well, they weren't giving on that. They were really wanting to use scaffolding to do the job. So we gave in. Okay, we'll pay you for the scaffolding. Awarded the contract to them, and we always send out contracting officers, representatives to go on site to see the progress of the work being done. And lo and behold, the first day of work, the contractor comes in with a cherry picker. They did not put up scaffolding. All right. Well, it was a firm fixed price contract. Nothing we could do about it other than make a note and put it in our back pocket. And the next time we negotiate with that contractor, shame on you. You tricked us. I'm not going to do it again. If I do it again, then it's shame on me. So we make note of contractors' performance. So that lends itself to means and methods. What are the means and methods of accomplishing that scope of work? Okay, which lends into profit also. Any questions on profit or fee? So when it comes to architect engineering, we call it fee. In service contracts and construction contracts, we call it profit, but they're interchangeable. Fee and profit is interchangeable. Any questions on profit or fee? Okay, moving on to bonds and insurance. So as I said at the beginning of the class, not all components you may need to include in your cost proposal.
Hey, Terry,
Yes.
I'm sorry to interrupt you. We did have a request for a short break. Can we do 3 minutes?
Yeah, sure.
Okay,
So
So, it's
come back to 226.
2:26. Ready, set, go.
Okay. So it looks like we're going to be on time because we only have about 3 slides left and it's approaching 2:30 and we go to 3 o'clock. So this is working out good.
Okay, awesome.
I see.
Yeah, we're scheduled to end at 3. Is that right?
Yeah,
Okay.
1 to 3. So I see lots of comments in chat. So I'm going to review those.
Yeah, I think I've addressed all the questions in there. So.
Okay. I see a comment in chat from Brenda that says, when is class, please? Not sure what that is.
Oh, I wonder, was that just to you or did I miss it? I might have missed it.
That was that one.
Oh, yeah, and then we gave her the link. Yep.
Oh. Link for a class?
Yeah, it was your indirect cost rate class people were asking about.
Okay.
Yep.
Oh, the date, okay. So I see a question from Verna. We are just providing professional services engineering. How does this affect us? Well, still got to put a cost proposal together.
Yeah, that was talking about prevailing wages.
Okay.
Yeah.
Yeah, I think I'll address that, provide some more information.
Yeah. Well, because Service Contract Act, does that not kick in for engineers?
It does. In fact, at Alliance Northwest, I attended one of the classes and the instructor misspoke in answering a question from an architect engineering firm in the back of the room.
Uh-oh.
I bit my tongue and I waited till the end and I was going to go talk to the architect engineer company representative and he escaped before I could get to him.
He got the answer he wanted and ran.
So he left the room with wrong information.
Oh, that's sad.
So I will provide a little information to architect engineering firms here when we come back to the class.
Okay, I have 2:27, so you got a bonus 60 seconds there.
Okay.
Welcome back, everybody. Thanks for Brenda for pointing out that we need a quick little bio break. Terry, take it away.
Okay, so I was just looking through the chat and saw a couple of comments that I want to expand on. One is from an architect engineering firm and wanting to know how the U.S. Department of Labor's wage determination affects them. And it does affect architect engineering firms also, because in a wage determination are types of employees such as CAD operators, cost estimators, and architect engineering firms have those employees in their staff. And so federal agencies, when they issue solicitations to architect engineering firms for design or research or studies or whatever, they need to be including Department of Labor wage determinations in those solicitations and the follow-on contract, because they have employees that are subject to those wage determinations, and the firm needs to pay at least what is in the wage determination. Okay, and I think there was one other comment. Nope, that was it. Okay. All right. So before we get into bonds and insurance, are there any other questions on anything we've covered so far? Okay, so we've only got about 3 more slides of material here, so we're on time for having a class from 1 to 3 o'clock. All right, so let's get into bonds and insurance. We talked earlier on the cost estimate sheet that it was one of your handouts. Bid bonds and payment and performance bonds. Your industry or your business might not be subject to having to provide those bonds, but as I mentioned early on in the introduction of the class, this is kind of like a worst case scenario. It's a large purchase, so I'm trying to include all various components of a cost proposal, where not everything may apply to you. So if a solicitation requires a bid bond, you got to go out and get that bid bond, and you're going to pay a premium for that. You want to put it in your cost proposal. As I mentioned before, if it's a construction type contract, you may have to provide payment and performance bonds. Well, you don't submit that with your proposal, but you're going to have to provide them typically within 10 days after the award of contract. So you still want to talk to your surety and ask them, what is it going to cost me for that payment and performance bond if I should win the contract? Get that premium, put it in your cost proposal, because if you win the contract, you're going to have to pay and provide those payment and performance bonds. Insurance. There are different types of insurance. There's liability insurance. If you're in the construction industry, there's going to be construction insurance. If you work around navigable waterways, you're going to want to get insurance for Longshore and Harbor Workers' Compensation Act. In parentheses, I put there a little bit of information as to where you might put that in your proposal. So typically liability insurance is in your indirect cost pool. Construction insurance is usually in your indirect cost pool. It could be a direct cost too. It depends on how you conduct your business. Longshore and Harbor Workers' Compensation Act, unless you are a company that only does work on navigable waterways, and if that's the case, then you would put your insurance for that specialty insurance in your indirect cost. But if you're only occasionally working on navigable waterways, then you would want to put it in as a direct cost in your cost proposal, because you're only buying it for this project. If anybody wants to talk further on that specific type of insurance, we can do that during the Q&A. I should have put a red asterisk there because I teach a class just on that type of insurance. You can find information on bonds and insurance in the Federal Acquisition Regulation, FAR Part 28. And I provided the website there, the link for you to go directly to the FAR Part 28. And there's all kinds of discussion in there about bonds and insurance, when they're required, when they're not needed, so on and so forth. The other important thing here is the last bullet, is the sureties. So if you are required to provide any bonds, whether it's a bid bond or a payment and performance bond or whatever, it needs to be from a company that is listed in the U.S. Treasury's website. Not all sureties are acceptable by the federal government. So if you, maybe before you call a company or after you call a company to get a premium, you want to check this website to make sure that they are accepted by the federal government. I mean, there's no point in going to a surety, getting a premium, putting it in your proposal, getting the award of the contract, and then submitting the bond to the contracting officer, because the contracting officer is going to go to that website to see if that surety is listed on there. And if they're not, they are going to reject that bond and send it back to you and say, do it again. And oh, by the way, it's due in 10 days. All right. Any questions on bonds and insurance? before we move on to taxes. Right? All right. Next page, taxes. This is another reason why I developed this class, because so many companies and contracting officers from the agencies are, yeah, we're moving on to the next page, page 24, is business and occupation taxes. So as a result, companies forget or don't know to include it in their cost proposal. So I've done the research on this, and I have found that there are 8 states in the United States that levy a B&O tax. And I have provided the list of the 8 there that levy a B&O tax: Washington, Oregon, Tennessee, Texas, Delaware, Michigan, Nevada, and Ohio. So if you are performing work in any one of those states, you need to be aware that that state has a B&O tax that they are going to collect if you are subject to it. So you want to include that tax rate. So a handout. We have a handout there on B&O taxes. It's kind of hard to find that website, so I'm providing it to you as a handout for this class. There are 2 handouts there. One of them is that one right there is 2 pages. And if you go down to the second page, I have highlighted for you. There you go. The B&O tax that you would have to pay on the bottom line value of your contract if it's a federal contract. And it comes under this heading here that includes government contracting. So if you have a federal contract, there is the rate that you're going to be charged by the state of Washington. It's 0.00484. You want to include that in your cost proposal. It's a cost of doing business. Okay. The next handout is a listing of all the counties and cities within the state of Washington that also are following suit of the state that they also charge a B&O tax. So if you, for example, are winning a contract, or you receive a solicitation for which you're going to compete for the award of the contract, and it is, say, in Kitsap County, which is where I'm at, in Kitsap County, and the work is going to be performed in the shipyard, Puget Sound Naval Shipyard. You're going to want to look up on this list, Kitsap County. And so we see there, Kitsap County is only for unincorporated areas. So if the job was in Silverdale, we call it a town, but it is unincorporated, you're going to have to pay B&O tax. And what is that tax rate? Kitsap County, unincorporated. And so there's 3 columns up there. So in the state of Washington, they have those 3 column headings are the local rate, the state rate, and the location code. So not real important there. So the rate there for the local rate is the center column. And you look up Kitsap County unincorporated, it's 0.027. So if you were doing a contract, a federal contract in the Silverdale area, Silverdale, Washington area, which is an unincorporated area in Kitsap County, you would also have to pay that tax rate to Kitsap County. Now, if we can go to the B's and look up Bremerton, Washington for the Puget Sound Naval Shipyard, we will see that it has also a B&O tax rate of 0.027. So you would want to include that in your cost proposal also. So worst case scenario. So companies have been putting in, submitting proposals for the award of a contract, and they forgot the B&O tax. Under profit, they put in 5%. And if you didn't put B&O tax, all the taxes that you're going to have to pay, then when the tax collector comes knocking at your door and wants that B&O tax on the value of that contract, where is that? You're going to have to pay it, but where's that money going to come from? If you didn't include it in your proposal, it's coming out of profit. So if you had a 5% profit, you are now shrinking your profit because you got to pay these taxes. Well, the same thing applies to your indirect costs. So many companies put in the cost to do the work, which is direct costs, labor, materials, and equipment, and they mark it up with profit, 10% profit, and probably put something in there for their liability insurance and submit it. Okay, so, because they didn't know how to compute indirect costs, or they don't know what it is. So they win the contract and they start performing, and say we go to this worksheet that you have as a handout, and their monthly or their daily cost is $391.76. That's per day. So if they didn't include it in their proposal, where's that money coming from to pay for all the people in the corporate office, in the headquarters? The only place it can come from is profit. So now you reduce your profit from 5% to 4% because of B&O taxes, and now you're further reducing it because you didn't include indirect costs, and now it's going from 4% to 2%. So you're doing a disservice because you didn't have a complete proposal that you submitted, and the worst case scenario, you could start performing on day one and losing money. So this is what drove me to put this class together, to help you consider all the components that you need to put in a cost proposal that could end up also being a price proposal, depending on what the solicitation is asking for. All right, so let's go back to.
Hey, Terry, before you move on from this sheet, we have a hand raised from Joan. And then before that, Dustin was asking about this combined sales tax number at here in this third column. So if it were in Aberdeen, to walk me through.
Yeah, I saw that too. And a few days ago, I was looking at that and scratching my head. It doesn't compute, because when you look at the column that says state rate, and on the other handout, which was the state of Washington B&O tax, they're not the same rate. And so
Terry,
there's misinformation there.
excuse me, this is Joan Baldwin.
Oh, hey,
I have a lot of experience with sales tax and B&O tax in Washington State.
Okay.
This form that you're using here is for sales and use tax only. And it's the sales tax, if you are subject to the sales tax rates in a particular city. For example, in the city of Basel, where I live, the rate is 10.1%, 6.5% of which is for the state of Washington. Basel does not have a B&O tax. Not every city does. And this is a little bit confusing using this particular form. Each city, for example, Bremerton, actually their B&O tax rate for wholesaling, which would be construction that doesn't charge tax, is 0.16%. So it's 0.0016. On retailing, it's 0.00125. So it's incumbent on the contractor to check with the location authority, the city or county that they're working in, to see if there is a B&O tax. But this schedule is incorrect.
Okay.
It's strictly sales and use tax.
Okay. Because in some places that's synonymous with B&O, but in this case it's not. And I didn't find a table for B&O tax for city and county. Although, as you mentioned, there are counties and cities that have followed suit after the state of Washington and levy a B&O tax also. So the main gist of this is you need to be aware of where you're performing your work and contact the local departments of revenue or chamber of commerce, whoever, to find out what taxes you're going to be subject to on a federal contract or a state contract, and include that in your cost proposal so you don't get caught later on and having to pay it out of your profit. Very good. Okay. So we're going to disregard that link there for cities and states that on there at the bottom, because it's the wrong one. It's the one for the handout that I gave you, which is misleading. And the information on the number of counties and cities it came from that listing also. So the main takeaway though, so for example, if you're in the state of Washington and you are going to compete for the award of a contract in Maine, you can see that it is not one of the states that has a B&O tax. So if you're using a template and you've always got B&O tax in there for the state of Washington, you're going to probably want to zero that out because the place of performance is in Maine. But then you want to check with the locality of where you're going to be performing and find out if they have any county or city taxes that you're going to have to pay. So you can include them in your cost proposal. Okay. Any other questions on taxes? I will revise that so you don't need to put it in your post-class survey. I've already got a note on that. Okay. Okay, we're opening up to questions and answers now. We've gone through all the slides for price proposal preparation. Any overarching questions that we want to talk about before I go into the summary page? All right, so let's go on to the next page, a summary. Remember all the components of a price proposal, price/cost proposal, which once again is direct, indirect, your profit, bonds, and insurance that may be applicable, and taxes. Include them all in your cost proposal. Calculate your indirect cost rate and review that regularly because that is an area that you have control over. If you can reduce your indirect rate, that makes you more competitive. Include your bond costs. Know your tax rates for the place of performance. And it's better to overprice than to start losing money on day one performing a contract. When I was a contracting officer for like 29 years as such, we are not in the business of putting companies out of business. And so on more than one occasion, frequently, when I sat down to negotiate a price, terms and conditions of a contract before award, and I got a contractor's cost proposal and I would review it, I would be a contracting officer who would identify things that they have not included in their cost proposal to make it a fair and reasonable price. It's for both parties, okay? And if they've overstated something or they repeated something, I would bring that to their attention. But I would also identify things that they left out, like B&O tax or your indirect rate, you know? So we want to make sure that we negotiate a fair and reasonable price. That is incumbent upon every government contracting officer. They cannot award a contract that is not fair and reasonable, and that's why they typically enter into negotiations. All right, so last page. See your local PTAC for assistance. That's what we're here for, and it's all free client services that we do. Our classes are free. Our consulting and advising is free. If you are in the Olympic Peninsula, where I'm at, our new point of contact is James Davis. There's his phone number and website. If you are in the state of Washington, there is the website to find your PTAC counselor elsewhere in the state. And if you are out of state, there's the website aptac-us.org to find your PTAC office, your counselor in other states of the United States. That ends the class for price proposal preparation. Any lingering questions that we can?
Go ahead, Dustin.
Hi, thanks. Yeah, I didn't get my hand raised quick enough before we moved on. So my question is, one of the things I've seen in a few proposals, as well as CDRLs for end of contracts that I didn't see in here, were ODCs, other direct costs. And I was never really able to find anywhere that defined those. Could you assist with that?
Yes, I had to deal with those. That's something I haven't thought about in years. That's the first
You're
time.
welcome.
Thank you. Stump the jump. Okay. That's the first time that question has come up in my retirement in almost 4 years. Other direct costs. Yeah, so there's indirect costs, the direct costs, and other direct costs. So typically, a firm will have an accountant or a CPA that they are working with. And that is a very pertinent question to ask those professionals about direct costs, indirect costs, and other direct costs. The federal acquisition regulation does go into other direct costs. I'm pretty confident in saying that for the purposes of our attendees here today, for the majority of the industries and the businesses that we're in, you're most often not going to be dealing with other direct costs. The large businesses, like the big 5 Department of Defense contractors like Raytheon and General Dynamics and whatnot, their accounting staff, and they probably got 100 people in their accounting staff, are dealing with those indirect costs and other direct costs and segregating them. And they have a corporate office overhead, and they have their G&A rate, and they've got books for commercial, and they got their cost accounting books for the federal government, and they got their cost accounting books for the state of Washington. So it depends on who comes knocking at the door, which books that they open up and show. So typically most companies have more than one set of books. So I've kind of skirted your question. I haven't dealt with other direct costs in my 4 years of retirement, and I very seldom had to deal with it as a contracting officer in my 29 years. So I'm not much help to you there, other than referring you to the accounting professionals, the CPAs and the accounting firms that you might be working with.
Okay, but you said you're pretty sure that FAR mentioned something, so I can just go on the acquisition.gov site and kind of search for that.
Yeah, search on other direct costs.
Okay, thank you.
You're welcome. Great question. Stump the contracting officer. You succeeded. Very good.
You
Anybody
can
else?
come to any one of our classes, Dustin. Keep him on his toes.
Right.
Well, I think I'm signed up for about 4 more this month. So that's a plug for everyone else. This is probably my 5th or 6th PTAC virtual class, and these are all super great. So I recommend going to their site, searching their events calendar, sign up for as many as you can. They're all phenomenal.
Yeah, so just as a reminder, at the very beginning in the introductions of this class, I talked about upcoming classes. So we did the solicitation review, which was a new class that I provided 2 months ago. This is a follow-on class to that. Is once you made that go decision to compete for the award of the contract, now you're gonna have to put a proposal together. So in a large procurement, which I said was over $250,000, there's typically 3 components of a proposal. There's the cover letter, the price proposal, and the technical proposal. So today we covered the price proposal. The technical proposal, I said, putting together a winning technical proposal was, I think, January 25th. So that's quite some ways off. But a more pertinent class that is coming in the near future here is next month. I have a class on contract modifications. That is November 15th from 8 to 10 o'clock in the morning. So I have, in my 29 years, I don't think I ever experienced a contract that didn't require a modification after award. So you're all probably going to experience that. And so this is a great class that just talks about contract modifications, all the ramifications of contract modifications. Okay, so there's a great class there. The solicitation review that Dustin was just talking about, that I presented for the first time in August, because we had a wait list of over 17 people, we decided to schedule another one, and that is coming up December 14th, December 12th and 14th. And it's not a class, it's a workshop. So after you attend the first day, you will have homework to come and present on this on the following day, which is 2 days later. So it's a workshop, and it's a great class too. So those are the classes that are coming up. Any other subjects we want to talk about? We are on schedule. Yes, it's 2:52. Okay.
Somebody asked if they are recorded, and we do record our classes and put them on our We usually do a blog post, and then we also put them on our YouTube page. So you can kind of see our hot topics here with links to our workshops. And if you have any trouble on our YouTube finding a workshop that you think we did, you're more than welcome to pop us an email and ask where it's at. And Joan has her hand up.
Yes, Joe.
Hi, Terry, I found a list of local tax rate, B&O tax rates in Washington at the website wacities.org.
WA Cities?
wacities.org.
And does that include counties?
It just says all the B&O taxes, and I don't necessarily see any cities listed, but
Or counties? Okay, yeah, I'll take a look at that. Great. Thank you very much for that.
okay, you're
So
welcome.
that will be an improvement for my next offering. of
Glad
this.
I could help.
Thank you. Now, and as a reminder, there will be a post-class survey that I hope that for the most part, that the majority of you complete and submit. That will help me improve this class because it's the very first time I've offered this class, and I'm always open to criticism and suggestions for improvements for the next time we offer this. Okay. Other than that, that's all I've got, folks.
All right. Well, thank you so much. I appreciate everyone hopping online today and for your talent and expertise, Terry, with this team here. With that, we'll adjourn and we'll see you at the next event.
Okay. Ciao.
Thank you.